Look at any financial media, and you are hit with a sensory overload of flashing red and green numbers, shouting analysts, and chaotic charts. The industry wraps the concept of building wealth in layers of dense jargon. It creates the illusion that you need a PhD in economics, an enormous bankroll, and nerves of steel to even participate. Faced with that wall of noise and perceived risk, it is completely logical that most of us back away and leave our money perfectly still in a standard savings account. The finance industry's noise acts as an artificial psychological barrier. It tricks us into choosing the comfort of doing nothing over actively building our financial future. If we tune out the shouting analysts and focus entirely on the math, we find a much simpler, harsher reality: inflation. Every single year, the baseline cost of housing, food, and energy ticks upward. This diagram shows exactly what happens when you leave your money sitting still. Your stationary cash is plotted on a flat line, while the cost of living steadily rises above it. The widening gap is your purchasing power evaporating. To close that gap, the cash must pivot upward, growing faster than your daily expenses increase. Keeping your cash locked in a savings account results in a mathematical, guaranteed slow loss. Investing serves as a mandatory defensive mechanism to protect the value of your labor. The moment you decide to put your money to work, you encounter a whole new set of buzzwords. Let's ignore the jargon. Investing is simply the act of buying a piece of something that generates value on its own. With stocks, you buy one tiny fraction of a business and own it. Finding the right single company carries risk, so experts take fractional pieces from hundreds of different companies and bundle them together into a single basket. That is a mutual fund. Then there is cryptocurrency. This graph contrasts a steady traditional asset with a digital alternative, showing deep drops and wildly accelerating peaks. That extreme movement means digital money can grow incredibly fast, but the mechanics of high-speed growth bring equally high-speed risk, making it dangerous for beginners. Stripped of the financial terminology, these different investment vehicles are entirely mechanical. They are simply different ways to balance how much risk you want to take against how much management you want to hand over to experts. There is a persistent myth that you need massive amounts of starting capital to even buy your first asset. Small amounts of money are highly effective because of the underlying mathematical engine of investing: compounding. Compounding is your money earning more money. Look at this loop. A small initial amount generates earnings. Those earnings merge back into your original pile, generating their own earnings in an accelerating cycle. As this timeline stretches, the massive exponential curve is entirely the result of this loop running for years. The initial dollars you put in are the spark. Time is the actual fuel of the wealth creation machine. Understanding this mathematical logic makes it easy to spot bad advice. You can actively ignore the loud voices on the internet promising you a shortcut to getting rich quickly. The math also highlights two clear errors to avoid. First, putting all your capital into a single place leaves you completely vulnerable if that specific business fails. Second, you should never invest the cash you need for short-term survival because the compounding engine requires years to operate. The actual process of starting is entirely straightforward. Learn the basic mechanics of how an asset generates value, take whatever small amount of cash you have right now, buy a fraction of that asset, and leave it alone. You do not have to watch the screens, and you do not need to time the market perfectly. Investing requires quiet, consistent discipline. By starting early and acting consistently, you strip away the anxiety of the financial industry. You let the math do the heavy lifting, granting yourself the ultimate financial advantage: the leverage of time.